webinar. I'm Joyce Liu, Investment Analyst with Phillip Futures. So the Federal Open Market Committee's decision is out. No tapering. And this outcome came as much of a surprise to most economists, analysts, and bankers. Gold rallied more than 4% in the minutes that followed the announcement, along with most stocks in the S&P 500 index. But it wasn't more than a day before the precious metal gave back all its gains. The aim of today's webinar, therefore, is to identify concerns of the FOMC committee that led to their decision to delay stimulus tapering, understand why the concerns, and lastly, make some forward-looking preparation that will aid us in preempting any likely decision by the FOMC meeting. Disclaimer: the purpose of this presentation is for general information and education only. For investment advice, please approach our Phillip Futures representatives for an analysis of your risks and returns. Comparing the September FOMC meeting statement with the previous meeting statement, there are three main points and a small but significant shift in tone. That shift in tone came from the first paragraph, where the pace of expansion in economic activity was described as moderate instead of modest. The word moderate was also used in the June FOMC meeting statement, after which Mr. Ben Bernanke said the Federal Reserve is ready to taper later half of this year depending on economic conditions. In the July FOMC meeting statement, after a slate of not-so-optimistic data and rising bond yields, the word moderate was changed to modest, and this change was highlighted by a discussion on Bloomberg TV. The conclusion: moderate expansion is a shade better than modest expansion. Therefore, the switch back to moderate from modest in this FOMC meeting minutes was significant. On top of this, there are three main points raised in the FOMC meeting minutes that is worth discussing. First, tightening financial conditions. The tightening of financial conditions observed in recent months, said Federal Reserve, if sustained, could slow the pace of improvement in the economy and labor market. Financial conditions have apparently tightened without any tapering of stimulus or upward adjustment to the federal funds rate. Second, federal fiscal retrenchment. Because of the federal fiscal retrenchment, Federal Reserve was not so confident of reducing stimulus now and prefers to err on the side of caution by waiting for more evidence of economic strength. The federal fiscal retrenchment Ben Bernanke mentioned refers to the episode of sequestration in first quarter this year. Third and last, asset purchases not on any preset course. And Ben Bernanke stresses that the decision to reduce asset purchases or not is contingent upon recent measures of economic performance. So today, we will discuss the three main points: tightening financial conditions, fiscal retrenchment, and economic conditions. First, tightening financial conditions. The tightening financial conditions that Ben Bernanke was referring to was the rising bond yields. Bond yields rose because of news that Federal Reserve, the biggest buyer of US Treasury bonds and mortgage-backed securities, is intending to cut back on their buying spree. Bondholders started selling off the bonds they hold. Prices of bonds fell, and the return on these coupon bonds rise. The effect of rising bond yields trickled down to home lending rates for consumers and corporate lending rates for companies. Let's take a look at the chart here. The chart here shows the 15-year and 30-year US home mortgage rates. Since late May, when rife speculations of paring back on stimulus first emerged, mortgage rates have risen more than 100 basis points, or 1 percentage point. The rising mortgage rates affect not only new home buyers, but also existing homeowners refinancing their loans. Basically, the rising bond yields are in direct opposition to Federal Reserve's hopes of stimulating consumer spending and corporate investments to grow the economy. When interest rates go up, consumers and corporates are less able and less willing to spend because the cost of financing and investment goes up. And the most worrying thing of all is that interest rates are rising without any tapering or stimulus or upward adjustment to the Fed funds rate. If the Federal Reserve indeed tapers, bond yields will almost certainly rise even higher. And along with bond yields, the US dollar is also most likely going to appreciate. The logic is simple. With less increase in US dollar every month to the liquidity inflated market, it is almost as if supply of US dollars is tightening. And with higher yields in the US, there will likely be movement back into dollar-denominated interest rate-related assets, driving up demand for US dollar. As a result, US dollar appreciates against other currencies, especially that of emerging markets, because of fund flow from EM countries back to the US. Stocks, on the other hand, are likely to take a hit. The S&P 500 index fell about 20% each time the prior rounds of quantitative easing ended, because the cost of funding for companies increases with higher yield and investors become more cautious or prudent with their money when the extra liquidity is withdrawn. US big bank stocks are probably going to be the only obvious exception. They are likely to outperform because they can operate in steadier markets and command higher interest income while cost of borrowing from central bank remains low. Gold is an obvious loser in this case. The higher yields will attract funds away from gold into other cash flow yielding assets. There will be less need for dollar depreciation hedge, as the outlook for dollar is more likely that of appreciation. There will be less need for inflation hedge, as rising interest rates reduces the prospects of demand pull inflation. There will be less need for crisis hedge, as the underlying justification for tapering is the economy has improved sufficiently such that a reduction in stimulus will not reduce growth. So fund diversion away from gold and less investment demand for gold will make gold a loser. The second issue is federal fiscal retrenchment, or sequestration. Recall Sequestration 2013, the $85.3 billion automatic spending cuts and civil servants retrenchment in the US earlier this year. According to the Congressional Budget Office, in the absence of sequestration, GDP growth would be about 0.6 percentage points faster in 2013, and the equivalent of about 750,000 more full-time jobs will be created or retained by the fourth quarter. And Nobel Prize-winning economist Paul Krugman reportedly estimated that the sequester could cost 700,000 jobs. This was the federal fiscal retrenchment Ben Bernanke was referring to. But hasn't unemployment rate been going down? Absolutely, but notice that the decrease in unemployment rate this time round was also accompanied by an alarming decrease in labor force participation rate. Labor force participation rate is the percentage of working age population who are employed or actively seeking to be employed. In prior times when unemployment rate decreases, labor force participation rate either increases concurrently or stays almost constant, which is normal. What does the decreasing labor force participation rate indicate? It indicates more and more people are getting discouraged and have given up seeking employment, either because job market is poor or there is structural unemployment where the jobs created do not match the skills of the people. Both reveal a deeper problem below the facade of better unemployment rate. And this is worrying for the Fed because this will not encourage spending. Next, we'll be looking at what economic data and what kind of events to watch out for. First and foremost, we look at economic conditions, where the conditions are in line with Federal Reserve's comfort level to start stimulus pairing. 3 goods of data to watch. labor market data. On top of the usual unemployment rate, non-farm payrolls, and initial jobless claims, we will also be watching labor participation rate. Second, prices, namely personal consumption expenditure inflation. Lastly, consumption and production data. Next, we are also preparing for large market movements when FOMC members who are scheduled to speak at various events and occasions give market further hints on whether the Fed is ready to taper. Historically, whether intentional or unintentional, these speeches drive gold markets. From now till the October FOMC meeting, these are the speeches lined up. We also look at fund flow. Funds have been flowing out from gold-backed ETFs since the beginning of the year, and these fund outflow contribute to supply of physical gold, as a result, pressuring prices at the same time. Total fund outflow since the beginning of the year is about 30%. However, there has been signs of slowing, and we are watching if the last trend is reversing to inflow again. This will be a change that reflects a major shift in sentiments that may send gold prices reversing to the bulls, but so far, the possibility is not in sight yet. Lastly, we look at technical indicators. The daily chart here shows a 5-wave main downtrend since early April this year. There was a 3-wave retracement from the trough of 1,180 on June 28th, and the peak of 1,433 reached in August is very likely the end of the retracement and the start of the continuation of the previous main downtrend. A close-up look at the hourly chart. Although prices did rise impulsively on the 18th of September in response to the FOMC statement, prices were supported only for a brief one day before plunging again. If prices break below the support of 1,310, it is likely to give back all its gains from 1,290. But for it to break out of the bearishness, prices have to break at least above 1,430, which seems like a tall order for now. We have now come to the end of our Gold Outlook webinar for September 2013. For more information on the risks and returns of trading gold futures, please approach any of our Phillip Futures representatives. Thank you, and please stay tuned for more market updates. I'm Joyce Liu, Investment Analyst with Phillip Futures.